Ever find yourself looking at an investment, maybe a company that seems really complex, and just wishing someone could, cut through the noise, just distill it down to what really matters for you?
Well, that's exactly what we do here on the Deep Dive. We take piles of reports, news, market data, and boil it all down into clear, actionable insights. Today, we're doing a deep dive into MARKETAXESS. Ticker is MKTX. They're a huge player in electronic bond trading. We're going to break down their business, their recent performance, and what it all means for you, the potential investor. We've looked at their financials, news, market trends, the whole picture.
Exactly. And we're not just listing facts. We want to get to the so what. Why should this company be on your radar? What makes it tick? And crucially, what are the key things you really need to keep an eye on if you're thinking about investing?
All right, let's start with the basics. Who exactly is MARKETAXESS? Because they're a U.S. financial technology company, a fintech, right? Started back in 2000. That's right. And their main thing is providing this electronic platform for big institutional investors. We're talking banks, big money managers, hedge funds to trade bonds, and not just one type. Corporate bonds, government bonds, emerging market stuff, munis, even more complex things like CLOs.
And they fundamentally changed how things were done, didn't they? The old bond market was, well, old-fashioned, lots of phone calls, emails, not very efficient, kind of opaque, really.
Totally. That's the core problem they solved. The over-the-counter, or OTC, bond market was historically manual, slow, and lacked transparency. MARKETAXESS brought it into the digital age, made it faster, more efficient, and crucially, much more transparent.
So how does that platform actually work? What are the key parts?
Okay, so there are a few main pillars. First, the multi-dealer trading platform, which is huge. It lets buyers and sellers see multiple bids and offers at once. So you get better price discovery, better liquidity. It connects everyone.
Makes sense, finding the other side of a trade easily.
Exactly. Then there's the market data and analysis side. They provide real-time pricing, historical data, all the stuff traders need to make smart decisions. And finally, post-trade services. Basically, helping with the back office stuff after a trade happens, making everything smoother operationally.
You mentioned liquidity. I hear their all-to-all model is a big deal.
Oh, absolutely.
Yeah.
That's probably their strongest competitive edge. The all-to-all model is, well, it's transformative. Think about it. Instead of just dealers providing prices, anyone on the platform can potentially provide liquidity to anyone else. Buyers can connect with buyers, sellers with sellers, buyers with sellers.
So it dramatically increases the number of potential counterparties for any given trade.
Precisely. It maximizes liquidity in a way traditional models just can't. And that deep liquidity creates a really powerful network effect. The more participants you have, the better the liquidity, which attracts more participants, and so on. It makes the platform incredibly valuable and very, very sticky. Hard for competitors to break in.
Okay, that model sounds powerful. Let's switch gears now and unpack the numbers game. How is this translating financially? Because one thing that stands out with MARKETAXESS is their history of pretty consistent growth and profit.
Yeah, they have a strong track record. And the latest results, Q2 2025, really underscore that momentum.
So lay it out for us. What did Q2 look like?
All right, revenue hit $178.6 million. That's up 6.8% from the same time last year. Net income was $78.1 million, and the diluted EPS came in at $2.06. Pretty much met, maybe slightly beat, what the market was expecting.
Solid numbers. But I heard the trading volumes were the real story.
Oh, definitely. Volumes were record-breaking. Total credit bond volume, that's corporate bonds, mainly went over $1 trillion. A trillion. Up 20% year over year.
Wow.
And then total rates, which is mostly government bonds, hit $2 trillion. That was up a massive 55% year over year, an all-time high for them.
Huge jump in government bonds.
Huge. And the overall platform average daily trading volume, the ADV, climbed to $49 billion. That's up 43% year over year.
And it wasn't just overall volume, right? Some key areas grew strongly too.
That's right. They saw good growth in higher margin areas. High-yield bonds and euro bonds were both up about 25% in volume. And emerging markets, ADV, saw solid 20% growth too. So broad-based strength in volume.
Okay, record volumes sound great, but is there a catch? Anything investors need to look closer at?
Yes, there is. And this is really important. While volume surged, the fees per million, or FPM, actually went down. For total credit bonds, FPM dropped 7%. For total rates, it fell 12%.
Okay, wait, so they're doing way more business but getting paid less for each chunk of it. Why is that happening?
That's the million-dollar question, isn't it? It could be a couple of things. Maybe a shift in the mix of products being traded more volume and lower fee instruments, perhaps like government bonds, which saw that massive spike. Or it could signal tougher price competition heating up in the electronic bond space. Competitors might be pushing fees down.
So for us investors, that means we can't just celebrate the volume growth.
Exactly, you have to look at both. Rising volume is good, but if the price per unit keeps falling, it could eventually pressure their profit margins, even with overall growth. That FPM trend is something you absolutely have to watch closely going forward. Can volume growth truly offset that decline long term? That's the key question for profitability.
Right, it's a balancing act. Volume versus unit profitability. You mentioned new initiatives were driving some of that volume growth.
Yes, absolutely. Things like customer-driven trading, portfolio trading, expanding their dealer-driven channels, these all contributed to those record numbers. It shows they're not just sitting back. They're innovating, responding to client needs, trying to capture more flow in different ways. That adaptability is crucial, especially against strong competitors.
Okay, makes sense. So beyond the trading itself, how does MarketAxess actually make its money? What are the main revenue streams?
Well, the biggest piece, unsurprisingly, is trading fees. Commissions from those bond transactions, especially corporate bonds, are the main engine. But they also have other important streams. Their market data services are quite valuable, selling that real-time and historical data. Plus, they charge connectivity and maintenance fees for platform access and some other smaller service lines. It's a pretty solid, diversified mix within the trading ecosystem.
Got it. Now let's talk valuation. How does the market see this company? You mentioned those strong numbers, but what about the stock price indicators?
Right, so as of, let's say, late July 2025, their market cap was around $7 billion. The price-to-earnings ratio, the PE, was hovering somewhere between 30 and 40.
That sounds pretty high, doesn't it, compared to the broader market?
It definitely reflects a growth premium. The market is pricing in significant future growth from the ongoing shift to electronic bond trading. It means MarketAxess really needs to keep delivering on that growth promise to justify that multiple. There's less room for disappointment.
What about other metrics?
Their price-to-book ratio, PBR, was around 5 to 7x. Return on equity, ROE, is strong, in the 15–20% range, showing that high profitability we talked about. Sales growth has been stable, typically 5–10% annually. And importantly, their balance sheet is very healthy. Very little, almost no debt. That's a big plus.
And for income investors, I heard they pay a dividend.
They do. MarketAxess is what you'd call a dividend growth stock. They've consistently increased their dividend payout for over 10 years now.
That's a good sign of financial health and confidence.
Absolutely. Now, the current yield is only around 1%, so it's not a high-yield play right now. The story here is more about that consistent growth in the dividend over time, rewarding long-term shareholders.
Okay, let's zoom out a bit. What's happening in the broader bond market and the electronic trading industry that affects MarketAxess?
Well, what's really fascinating here is just how much potential is still left. Compared to the stock market, which is almost entirely electronic, a large chunk of the bond market, especially certain segments, is still done manually.
Still, even now.
Yep. So there's this huge runway for electronic platforms like MarketAxess to keep growing just by converting more of that manual trading over. Plus, institutional investors are constantly demanding more efficiency, better pricing, more transparency, all things electronic platforms deliver.
And technology keeps advancing too, right?
Exactly. Things like AI, machine learning, better automation, they're making these platforms smarter and more powerful. Regulations are also a tailwind. Rules like MiFID II in Europe, which push for best execution, proving you get the best possible price, naturally drive more flow onto transparent electronic venues. And the need for real-time data is only growing.
So strong tailwinds. But it can't be easy. What about competition? Who are they up against?
Well, it's definitely a competitive space. You don't dominate a market like this without drawing rivals.
So who are the main ones we should know about?
Their biggest, most direct competitor is Tradeweb Markets, ticker TW. They're also a major electronic platform, particularly strong in government bonds and swaps, the OTC derivatives market. MarketAxess and Tradeweb are really the two giants kind of dividing up the electronic bond trading world.
Okay, Tradeweb. Anyone else?
Then you have Bloomberg. Everyone knows the Bloomberg terminal.
Wow.
They're a massive force in financial data and news, and they have their own electronic trading capabilities built into that ecosystem. Their strength is that huge existing terminal user base and the integrated nature of their offering.
So against Tradeweb and Bloomberg, what are MarketAxess's key advantages? How do they fight back?
Well, we keep coming back to it, but that all-to-all model is a huge differentiator, especially for liquidity in corporate bonds, which is their core strength.
Sure.
They also have incredibly deep market data and analytical tools, which clients rely on heavily. And that network effect we discussed, the liquidity flywheel, is a major barrier to entry. It's hard to replicate that scale.
Makes sense. Now, how do bigger economic forces play into this? Things like interest rates, inflation.
They play a surprisingly big role. Think about central bank policy, the Fed raising or cutting rates or doing QE or QT. All of that directly impacts bond prices, how easily bonds can be traded, liquidity, and overall trading volumes. Sometimes higher volatility actually increases trading as people adjust portfolios.
Interesting. So volatility isn't always bad for them.
Not necessarily for trading volumes, no. Then you have inflation and general economic growth affecting how many new bonds are issued and overall investment appetite. Geopolitical risks can shift money into safer government bonds or create turbulence in emerging markets, affecting trading patterns there.
And you mentioned regulations earlier, like MiFID too.
Right. Regulations globally that push for more transparency generally help electronic platforms. And just the overall trend of fintech and digital transformation sweeping across finance is a massive tailwind for companies like MarketAxess.
Okay, let's try to pull this all together. Thinking about MarketAxess as an investment, what are the core strengths we've identified?
Number one is their leading market position, especially in corporate bonds. Then there's that powerful network effect from their liquidity pool. They benefit hugely from the structural growth of electronic bond trading overall. They're highly profitable, generate strong cash flow, and keep investing in tech like that new platform for Indian government bonds.
And shareholder-friendly too, with the dividends.
Exactly. Shareholder-friendly policies plus capable management. Those are the big positives.
All right, now the flip side. What are the major risks investors need to keep on their dashboard?
Competition is definitely top of the list. TradeWeb and Bloomberg aren't standing still. That's constant pressure. Then, as we stressed, that fees per million, FPM, decline. Is it temporary? Can volume truly keep outpacing it? That's critical for long-term profitability. You have to watch that trend.
Okay, competition, FPM pressure. What else?
Broader market risks. A sudden drop in bond market liquidity due to some macro event could hurt volumes. Like any tech platform, they face risks of system failures or cybersecurity attacks that could damage trust. And finally, that high valuation we talked about. It means the market expects continued strong execution. Any stumbles could hit the stock harder than a lower valued company.
Briefly, what about the stock chart itself? Any technical insights?
Well, the sources suggest that for a company driven by strong fundamentals and clear growth trends like MarketAxess, the stock chart tends to show a relatively stable upward path over the long term. You'll always have short-term bumps, of course, but things like moving averages generally reflect that underlying fundamental strength rather than wild speculation.
And what about their internal strengths? What allows them to compete and grow?
It comes down to a few things. Their technology leadership constantly improving the platform. Their unique data assets and analytical capabilities, clients pay for that insight. Their proven ability to expand globally, like the India example shows.
Oh.
Strong relationships with those big institutional clients. And just the efficiency and scalability of their core platform business model, it scales well.
Okay, so boiling it all down, what's the final takeaway for, say, an American investor looking at MKTX?
Look, MarketAxess seems really well positioned for long-term investors who want exposure to the ongoing digitization of the massive bond market. They have a strong, profitable business model, a healthy balance sheet, and they return cash to shareholders.
But with caveats to monitor.
Absolutely. Keep a very close eye on that FPM trend. Watch the competitive dynamics, how are TradeWeb and Bloomberg responding. Pay attention to major shifts in interest rates or the macro environment. And continually ask, does the company's performance justify that premium valuation?
Great analysis. Yeah. So one final thought to leave our listeners with. We've seen how MarketAxess transformed bond trading. What other big, traditionally manual or opaque markets out there might be next in line for this kind of fintech disruption? And what could that mean for future innovation and investment opportunities? Something to think about. If this deep dive has been helpful and insightful for you, please subscribe to the deep dive.